MAP active, Mitra Adipakasa active. This is what happened in the first quarter. So the sales growth has slumped from 21% in the fourth quarter to -3% in the first quarter. This is the breakdown we have, retail and non-retail. So it's the non-retail, which is very weak, not quite sure what that is. Anyway, we assume with the shopping centres reopening that the second quarter is flat, and then there is something of a recovery, but that will still be growth of -10% over the next 12 months. In cash flow, the cash flow has also slumped. This is excluding the working capital, which is positive. What they've done is they've got some leasehold assets, which so if we take that out, the cash flow has actually dropped to -107 billion over the last 12 months, and if we take out, you can see that the first quarter is very negative, 468, as the sales dropped. Anyway, we see that things will come back in the next 12 months, and we're forecasting 350 billion of cash flow again, so back up. In the balance sheet, they were in net debt until the end of 2017. Then they had the equity injection, and then the cash built up to 532 billion by the end of last year, but that has dropped back to 239, and would have been more but for the would have been a bigger drop but for the working capital. So the profit also down by half. That's because of this higher depreciation, and that's been caused by this leasehold asset that they now have, which they're depreciating. The cash cost ratio is at 84%, 87% for the last 12 months. But that looks to us not to be quite right. It's not reflected in the cash flow. So we're using a more conservative 90% cost ratio, and we get a decline in the net profit by 42% as a result. This is the free cash flow, and we're using our 1.6% valuation with a 40% discount because we're a little bit uncertain about what's happening with the cost and the cash flow, but that gives you a higher target price of 4,700, which would look like that.